Hello, everyone. Mr. Lipchick here, and today we're going to talk about the Federal Reserve System, which is the tool that the federal government uses to control monetary policy and influence the money supply. Okay, the Fed began, or at least the idea of it began in the 1700s, and it has been debated. Its role has been debated since 1790 when the first Bank of the United States was created. There was disagreement as to whether we should have a Federal Reserve Bank. The debate is centered around the amount of control a central bank should have over the nation's banking system. And early Americans feared that centralized control of the monetary system would give an undue amount of control to the wealthy. Okay, and this was a legitimate fear considering the society that they had lived in prior to the Revolution, with aristocracy and things like that. Until the 1970s, the U.S. used representative money in the form of banknotes. And in the early 1900s, you could exchange these notes for gold and silver at banks. You could actually get gold and silver coinage. In the panic of 1907, a major recession, people began to make runs on their banks in order to exchange their notes for gold. And the banks, however, did not have sufficient gold on hand. And this is a problem with representative money. Okay, there's a lot more to a monetary system than simple precious metals. And this inspired the creation of the Federal Reserve banking system by Congress. Okay, and this came in the form of the Federal Reserve Act. The Federal Reserve Act of 1913 created a Federal Reserve System, which is a group of 12 regional independent banks. And power in the initial system was very decentralized. They did not want people fearing central control by the wealthy. And initially, the Federal Reserve System did not work well because bank actions from one region would counteract bank actions from another. Okay, there wasn't sufficient coordination. In 1929, with the stock market crash and the Great Depression, the need for a stronger reserve system became very evident. And some banks saw the need for pumping money into the economy, while others were more concerned with administrative issues. And therefore, the system did not respond to the crisis very effectively, and changes to this system needed to occur. In 1935, Congress adjusted the Federal Reserve structure so that the system could more strongly respond effectively to a national crisis. And today's Fed has more centralized power, so the regional banks can work together while still representing their own concerns. The Board of Governors of the Federal Reserve System is a 7-member board, and actions taken by the Federal Reserves are called monetary policy. The Federal Reserve districts consist of 12 reserve districts with one Federal Reserve bank per district, and the Federal Reserve banks monitor and report on economic activity within their districts. And if you take a look at the left, the way they were initially constructed was it was done in order to reflect the amount of people and population and business activity within a particular area, with the western areas being less populated, at least at that time. Member banks are all nationally chartered and are required to join the Fed. Member banks contribute funds to join the system and receive stock and dividends in return. And the ownership of the system by banks, not the government, gives the Fed a high degree of political independence. And this is important to keep, political people who may not understand this system very well from basically enacting some extreme policy which could ruin the economy. And the Federal Open Market Committee, or FOMC, consists of the Board of Governors of 5 of the 12 district bank presidents, and this makes key economic decisions about interest rates and the growth of the U.S. money supply. Okay, so the 5 most populated or powerful districts make the majority of the decisions. About 40% of all banks belong to the Federal Reserve and hold about 75% of U.S. deposits. The Federal It is the federal government's banker, maintains a checking account for the Treasury Department, processes important payments for Social Security and IRS refunds and major things like that. And it is the financial agent of the Treasury Department, okay, and other government agencies. And it sells, transfers, and redeems government securities, as well as handling funds from T-bills, T-notes, and Treasury bonds. All right, issues currency. It's responsible for issuing paper currency, but keep in mind that the Department of the Treasury issues coins. Okay, but the Federal Reserve issues the banknotes. And check clearing is processed through the Federal Reserve. And this is where banks record which account gives up money and which account receives it when you write a check. After you write the check, the recipient presents it at his or her bank. The check is then sent to a Federal Reserve Bank. The Reserve Bank collects the necessary funds from your bank and transfers it to the recipient's bank. And your process check is returned to you by your bank. And more this process is becoming an electronic process. The Federal Reserve also coordinates and regulates the banking system. The Federal Reserve examines banks periodically to ensure that each institution is obeying laws and regulations. This is very important. If people are going to have confidence in the banking system, the system has to be honest and it has to be monitored. And examiners may also force banks to sell risky investments if their net worth or total assets minus liabilities falls too low. So banks are allowed to invest money. However, if their investments are in junk bonds or risky stocks or something like that, a bank examiner can force a member bank to sell those things. Okay, and the bank examiner comes in frequently and can come in any time to make sure that the bank is operating properly and that there's no fraud going on. Each financial institution that holds deposits must report daily to the Fed about its activities and what it has in reserve. And the Fed uses these reserves to control how much money is in circulation. The Fed, its best known role of the Fed, of course, is the regulation of the money supply. Like other commodities, money is subject to supply and demand. And the Fed monitors the money supply and measures the current demand for money. And it does this as an effort to keep inflation under control. Demand for money is affected by the following factors: cash needed on hand, interest rates. Higher rates lead to a decreased demand for cash. Price levels within the economy. As prices rise, so does the demand for cash. And a general level of income. As incomes rise, so does the demand for cash. Okay, that summarizes our lesson for the Federal Reserve System. Thank you for attending, and I look forward to speaking with you in the future. Have a great day.